Imagine you find a $20 bill on the sidewalk, and the very same day, you lose a $20 bill out of your wallet. Mathematically, you are exactly where you started. But here is the thing, almost nobody feels that way. The found money feels like free cash, easy come, easy go, so you spend it on something indulgent. The lost money feels like a genuine hit, something to mourn. Same dollar amount, completely opposite emotional reactions. That is not a personality quirk. That is a documented quirk of human psychology called mental accounting, and it is quietly draining the bank accounts of millions of people right now, including people who think of themselves as financially savvy. The term was coined by behavioral economist Richard Thaler, who later won the Nobel Prize in Economics in 2017, partly for this very work. The core idea is simple but stunning. We do not treat all money as equal and interchangeable the way a spreadsheet would. Instead, our brains file money into invisible mental categories, like folders on a computer, and the rules we apply to spending from one folder are completely different from the rules we apply to another. A dollar in your checking account feels different from a dollar in your vacation fund, even though they are literally the same dollar with the same purchasing power. And those invisible folders, those mental buckets, end up driving decisions that can cost you thousands over a lifetime. Over the next few minutes, you are going to see exactly how this trap works, where it shows up in everyday life, and most importantly, how to start thinking your way out of it. So, where does mental accounting actually show up in real life? Everywhere once you start looking. Here is one of the most common examples: tax refund season. Every spring, millions of people receive refunds and immediately start planning how to spend them on vacations, gadgets, or home upgrades they would never have bought with their regular paycheck. Here is the financial reality though: a tax refund is not a bonus or a windfall. It is money you already earned. It is your own wages that the government held interest free for up to 12 months and is now returning to you. But because it arrives in one lump sum through a separate channel, the brain labels it found money, and the usual spending restraint flies out the window. Studies have shown that people spend a significantly higher proportion of tax refunds on discretionary items compared to how they spend regular income of the same size. The mental bucket labeled unexpected money has almost no guardrails on it. The same thing happens with credit cards, and this one is especially dangerous. When you pay with a card, the money leaves a mental bucket that feels abstract and distant. When you pay with cash, it leaves a bucket that feels immediate and real. Research has shown that people consistently spend more when using credit versus cash for the exact same purchases, not because they are reckless, but because the mental accounting system treats the two payment methods as drawing from different buckets with different emotional costs. Casino chips work on the same principle, by the way. Once you convert your dollars into chips, your brain partially stops seeing them as real money, and spending becomes much easier. The bucket has been relabeled. Now, here is where mental accounting gets genuinely expensive in ways most people never notice. Think about savings accounts. Many people maintain multiple savings accounts with labels like emergency fund, vacation fund, new car fund, and holiday gifts. On the surface, this sounds like great financial organization, and honestly, some structure is genuinely helpful. But here is the trap hiding inside that system. Imagine someone has $3,000 sitting in a labeled vacation fund while simultaneously carrying $2,000 in credit card debt at an 18% annual interest rate. From a pure math standpoint, that situation makes no sense. The credit card debt is costing them roughly $30 a month in interest, while the savings account is likely earning almost nothing after inflation. The rational move is obvious: pay off the debt, then rebuild the savings. But people resist this furiously. Why? Because the vacation fund bucket has been mentally labeled vacation, not debt payoff. Touching it feels like robbing a future version of themselves. The money in the vacation bucket does not feel like it is available for the debt bucket, even though financially they are completely interchangeable. Thaler documented cases like this repeatedly. People would borrow money at high interest rates to fund purchases while simultaneously keeping equivalent savings locked in low yield accounts, simply because the mental labels prevented them from seeing the two pools of money as the same resource. There is also a version of this that plays out with windfalls and bonuses. People treat money from a bonus as more expendable than money from their regular paycheck, which means bonus money often disappears into lifestyle spending instead of going toward goals simply because the bonus bucket carries fewer rules. Here is where it gets interesting. Mental accounting is not purely a flaw, it is a cognitive tool, and like most tools, it can be used well or badly. Research into the habits of people who successfully build wealth over time shows that many of them have learned to hack their own mental accounting system rather than fight it. Instead of ignoring the bucket instinct, they redirect it. They create intentional mental labels that serve their goals rather than undermine them. For example, rather than spending a tax refund because it feels like found money, they pre label it as future net worth money before it even arrives. The label shifts the mental bucket it lands in, and the spending behavior follows. This is not just motivational talk, it connects to real research. A study by behavioral economists Drazen Prelek and Duncan Symester found that when people mentally pre commit purchases to a specific category or purpose, their follow through rate improves substantially. The label changes the behavior. Wealthy people also tend to do something subtle but powerful with debt. They refuse to let themselves maintain two parallel pools, one of savings and one of high interest debt, because they have trained themselves to see money fungibly. Fungibility is the technical word for money, all being interchangeable, and high earners tend to apply it ruthlessly. A dollar carrying an 18% interest rate is not the same as a free dollar sitting in savings. Understanding that removes the illusion of comfort that those savings buckets can create. The takeaway is not to eliminate your mental categories, it is to audit them. Ask yourself whether the buckets your brain has created are working for your financial future or against it. So, what can you actually do with all of this? The first step is the most powerful one, and it costs nothing. Start seeing your money as a single pool rather than a collection of labeled containers. This does not mean you cannot have savings goals or designated funds. It means that before you decide where money goes, you run it through one honest question. Given everything I owe and everything I am trying to build, is this the highest value place for this dollar right now? That one question dismantles a huge amount of mental accounting damage because it forces the conversation between all your buckets at once rather than letting each one operate in isolation. The second shift is to reframe unexpected money immediately and deliberately. When a refund, bonus, or gift arrives, do not let your brain autofile it as free spending money. The moment it lands, give it a new label that serves your goals. Even saying to yourself, this money is going toward financial breathing room, is enough to change how your brain treats it. The third shift is to audit your current mental buckets honestly. If you are holding savings while carrying high interest debt, the math is almost never in your favor. The comfort the savings bucket provides is largely psychological, not financial. Recognizing that illusion is not easy, but it is genuinely worth doing. Mental accounting is one of the most deeply human tendencies in all of personal finance. It helped our ancestors categorize resources when budgeting was literally a matter of survival. But in a modern economy with complex interest rates, credit systems, and long investment horizons, those ancient instincts need updating. The good news is that understanding the trap is most of the work. If this opened your eyes to something new about the way your brain handles money, do the channel a favor and hit like and subscribe so you never miss another lesson like this one.